I'm the founder of Trading Trainer, and I like these things to be a little bit on the participatory flavor. So let me just go through a quick little slide that I like to show up here. On your webinar control panel that I think you have in the upper right-hand corner of your screen, unless you moved it around, I want you to notice that there is an orange button that has a white arrow on it. In the old days, it used to look like this button. And I want you to press it. What that's going to do is it's actually going to squeeze that webinar control panel off your screen, freeing up much needed valuable screen real estate. For some reason, the webinar software people put their webinar control panel up in the upper right-hand corner, which is the business end for us traders. The other thing I want you to do is I definitely want you to press the full screen button, because I'm going to go into some details with some charts and some graphs and some tables on diagonal spreads, diagonal debit spreads, diagonal put debit spreads. I'm also going to give you, I'm not going to be giving you any sort of like pitch at the end. I know a lot of people have been pitching you today. I just want you to download some of my white papers that I just wrote. The other thing I like to be able to do is I like you to be able to raise and lower your hand when we're talking, so I make sure that you're all paying attention. So I like to interface with you so you can raise your hand at me. There's actually a virtual classroom going on here. So with all that said, let's get going. I'm going to go ahead and clear my screen here. And as I was saying, I am AJ Brown. And I guess the only thing I got to ask you is, well, how many of you with the show of hands have heard of me before? And I guess the more important question, I see quite a few hands going up actually. How many of you with the show of hands have never heard of me before? All right, fantastic. So the scoop is, and this is really the main thing, I've been doing this Trading Trainer education company since 2002, as Renee mentioned, and I've been trading since 1997. And the scoop is we started a foundation. I started a foundation first. It's a non-for-profit foundation where I teach inner city gangbangers out of Chicago how to teach them to trade options, how to teach them to invest their money, how to teach them to be in control. A lot of times they're not, which is why they're gangbangers, because they can be in control of the street. And what I soon found out about that is that you need money to run a foundation. Even if you've partnered with the CBOE like I have, you still need some money coming in. So that's why I created Trading Trainer, a for-profit school in 2003, because basically what we do is any of the profits from our school go right into the non-for-profit. And that creates a really neat dichotomy, because you'll notice that a lot of people who pitch you products, pitch you education, they have found out that if they sell you a product for $497, $997, $2,997, that they'll make more money than they do investing. And so by doing what I have done over 15 years ago, all of my coaches and we have to trade, otherwise we wouldn't make a living. Because all the education we sell, the money doesn't come to us. So it's a neat thing, because when you talk to anybody at Trading Trainer, you know that you're talking to somebody who's trading. Whereas some of the times you find out that people who are selling education haven't been trading in years or at all. So that's the scoop. I trade options to support myself. I don't make a penny off of my teaching. And I guess that's really what I wanted to emphasize. I always like to run through this quick little test. Most of you have seen it before, but if I was to give you $50,000 right now, or give you a penny doubled every day for 30 days, which would you take? How many with the show of hands said $50,000? Raise your hands. All right. How many with the show of hands say a penny doubled every day? There you go. The scoop is if you take that penny doubled every day, it turns out that it isn't until day 23 of a 30-day month that you've actually beat the $50,000, but it soon appreciates much after that. What if we doubled our portfolio annually? Well, first of all, I hope not anybody is starting with a penny for a portfolio. They're not going to get much orders out of that. But if we did, it would 30 years, we'd have $10 million. Most people who are putting money into some sort of tax-free account, they can max it out at $5,000. So if you start here with a $5,000 account, then 11 years, if you're doubling your portfolio annually, you could have up to $10 million. What if you're doing better than that? We just created a program. We didn't actually just create it. We just renamed it. We've been running this program since 2008 called the 6% Protocol. And it's a premium program. We've got a screener. Here it is right here, actually. If I bring over a browser window and I log into our Learning Community web portal, you'll see what it's all about. Login.tradingtrainer.com. This picture of me, by the way, is from 10 years ago. I've got a lot more gray hair now since I've turned 44 years old. But we've got a screener that screens out every evening all the highest probability premium trades that we could be taking. And of course, we've got all kinds of webinars and video tutorials that are part of that program. But today I wanted to talk about the fact that there are so many leading indicators right now telling us that the market is going to turn down. So let me ditch out of this. Let's just freewheel it here. HSBC, Citigroup, Morgan Stanley, all saying that the market is oversaturated, hinting that in the fall there's going to be a downturn. Now, for us premium traders, what we like are charts that go. A lot of times I teach all the technical indicators in order to determine if a chart is nicely going sideways. I'm not going to do that today. You can actually go, and I'll show you at the end of this presentation how you can go get my white papers that explain that. But take, for instance, Goldman Sachs. Let's look at a weekly 2-year chart on Goldman Sachs. Weekly 2-year chart on Goldman Sachs says, since about March of this year, has been trading horizontally. Now we can use all of our different tools. We could use fractal patterns. We could use point and figure charts. We could look for tested lines of support and resistance. We could use our Bollinger Bands. We could do candlestick count. Got 10 different methods to determine if something's really trading nicely sideways. But the scoop is we can trade this for selling premium. Our idea is to sell premium against an asset every month, every week, whatever option series we want to use. Every cycle is the more generic term. And we get our doubling of our portfolio every year. Let's go ahead and go back to a 6-month daily chart. Now, one way to do that, of course, is covered call writing. That's where you buy the stock. Let's go ahead and see if we can't draw a line here. You buy the stock, you can leg into it, meaning you buy it at a low. We always like to buy when things are at low prices and sell when they're at high prices. So we can buy a stock when prices are low, right after we've tested a bottom. And then every time price is at a high, right after testing a top, we could sell some premium. And that's a good way to be pulling this sort of trade. It's called legging into a covered call. What we wind up doing when we do that, let's get our math out, is say, for instance, we buy to open a share of Goldman Sachs. Now, of course, with options, you're going to be doing lots of 100, but you buy to open a share of Goldman Sachs, and then you're going to sell to open a near-term at-the-money option to get the premium. So Goldman Sachs, in this case, October we can actually just do the algorithm right now. So if we bought it right this minute with the prices we can get, we would buy to open at $229.32. This is considered a buy right, not so much a legging in, because if you were legging in, you'd want to leg in at the bottom of the channel at a much better price. And then if we go over here and we look at the October expirations on October 20, why don't we see about selling some premium? Where's our level of resistance? Maybe up here around $230. So maybe $232.50, trading somewhere between $4 and $4.10. So if I sold it at $4.05, it would probably be grabbed up. So if I did that kind of transaction, this is the Goldman Sachs October $232.50 call. I would wind up reducing the amount that by selling a premium against this by $4.05. I'd reduce the premium down to $225.27. That's called our cost basis. It's also called our break-even price. Now, where would the max profit occur on this particular trade? The max profit would occur if I get called out at $232.50. So my max reward, otherwise known as profit, would occur at the call out price, $232.50. So if on the third Friday of October, October 20th, I'm above $232.50, I'm going to get called out, and that's where I'm going to make my max profit. So what would that max profit be? $232.50 minus $225.27, $7.23. How many with the show of hands are following so far? Good. Now, taking that 723, we could also figure out what that percentage would be by dividing it by the cost basis, 225.27. And that would be about a 3.2% return. Now, what about my max risk? Where's my max risk? Coming back to the chart, I could either use a protective put or I could use a stop loss order. It looks like our level of support was around $215. So if we got below $215, I'd want to bail out. If I got below $215, I want to take my money and run, take whatever hits I have to take on the head, and go away. So let's set our stop loss order at $215. So that's the max risk, otherwise known as loss, at $215. That's my bailout price. Now, of course, in reality, when I did that order, I would put a stop loss order in at $215, and then I would put a contingent order to buy back that call. If I was down at $215, that call would be worth nothing. It would be worth whatever the market makers need to keep liquidity in the market, maybe a nickel. Depends on which exchange it is. Could be as low as a penny. So that bailout price, $215 compared to $225.27, I could actually do the math in my head. I would lose $10.27. And if I wanted to figure out what that is in percentage points, divide it by the cost basis. 225.27 gives me 4.5%, maybe 4.6% if I'm rounding. Now again, this is the workup for a buy right. That means I buy the stock and sell the option right at the same time. That's not what I would actually do. I would buy at a low, sell at a high, and cycle this thing over and over and over again. So I would get a much better price than 229.32.
Okay, good.
Somebody's talking in the background. I would buy this price at a much better price than 229.32. I don't know if I'd get much higher a price than $4.05 because I'm up at the top of the channel, but I would try. I would wait for this thing to cycle, and selling premium is a long-term game. All right, so this would be basically the worst case scenario. 3.2 max reward profit, 4.6% max risk. But let's talk about now actually where our profit and our trade zones are. So our profit zone is anywhere from the cost basis up to our call out price. So if I was to draw a line here, 225.27, right about here, up to 232.50. This is my profit zone. Now I've got this bailout price down at 215. This is my trade zone. Every cycle of option premium is going to lower my profit zone until ultimately it gets lower than my trade zone. And then, of course, I'm not dealing with whether it's a max reward or max risk. It then becomes a max reward or a min reward. Min reward would be down to the downside. Max reward would be up to the upside. And as each cycle goes by, the min reward gets larger, so does the max reward. And that's where we like to be. Typically, when we leg into these things within 2 or 3 cycles, we've got a risk-free trade where we're not worrying about what kind of risk we're going to have. We're worrying about what sort of reward we're going to have. But now we've got all these discussions about downturns. And people are saying, well, what if we get called out in the first month? Or what if we get bailed out in the first month? Or all of our trades all of a sudden going to hit us on the head? Now, of course, we factor in adjustment strategies. Of course, we factor in position sizing. So it's not going to be the end of the world if that happens. But what if instead of writing covered calls, we write covered puts? So we're going to profit max to the downside. Let's work through that scenario. So how do we do a covered put? First thing we got to do is short the stock. We'll go and do the same workup as we did with the covered call. So we'd first short the stock, 229.32, sell to open Goldman Sachs. Now, once you've shorted the stock, the next thing you're going to do is short the put. Which put are we going to go for? Let's take a look at the series. By the way, how many of you with the show of hands are following? And how many of you with the show of hands are completely lost? Great. We got a lot more people engaged than I was hoping. Let's keep going here. So where are we going to go with these particular puts in the October series? How about we go down to 220 for now? 220 is trading somewhere between $2.22, $2.24. We'll go with $2.23 in our math. We'll sell to open our Goldman Sachs October 220 put. So now what's our cost basis? Remember, in this case with the covered call analysis, we were buying first and we were selling later. Now we're selling and we're selling. So it turns out that our cost basis goes in the up direction. Our cost basis is now 229.32 plus 223. $231.55. This is our break-even price. We're dealing with a covered put, which means that everything works topsy-turvy. Going up works against us. Let's take a pause here and make sure we're clear on what's happening. With respect to legging in, let's see, we like to buy stocks or buy ETFs or buy indexes or buy deep in the money calls. I'm just going to use stocks as a generic term. We like to buy stocks at lows. We like to buy calls at lows, and that's when the stock is low. And we like to sell puts at lows. Puts are at lows when the stock is low, because puts work backwards. What about shorting stocks or selling stocks? At highs. You might want to take notes on this, by the way. We also like to sell calls at highs, and that's when the stock is high, right? And finally, we like to buy puts at highs, which happens to be when the stock is high, when the stock is low. Sell puts at lows when the stock is high. I'm sorry about that. I got that backwards. There we go. Buy puts at highs when the stock is low. Sell puts at lows when the stock is high. So whenever you're dealing with the puts, things are going backwards. That's the key thing to remember. So in this case, our cost basis goes up instead of down because we're both selling the stock and then selling the put. 231.55 is now our cost basis, our break-even price. Where is our max reward? Our call-out price. Where would this trade unravel for us? 220. The strike price. And where would we get bailed out at? If things are working topsy-turvy, we got to create either a call, a protective call, or basically a contingent buy to close order at 230. So let's do our math. If we get a max profit at 220, that's where we would get unraveled at. I can do the math in my head. Our reward would wind up being $11.55. Let's remind ourselves, by the way, what the definition of selling a put is. If I sell somebody a put, that means I have an obligation. Please write this down. I have an obligation to buy that person's stock at the strike price at any time between now and expiration. I have that obligation. In other words, if somebody buys a put from me, say for instance, they bought a 215 strike price put from me, and the price of Goldman Sachs drops to $210. On the day of expiration, they would be in perfect acceptability if they went out and bought stocks at the low price, 210, and then immediately made me buy it back at 215. How many with the show of hands follow? That's what a put allows people to do. Now, most of us would just sell the put because it too would appreciate in value, but in effect, what somebody could do is on the expiration day, they could go out and buy stock at whatever low price it is and then force you to then buy the stock from them at the higher price. Does that make sense? How many of the show of hands does that make sense? So when I sell this October 220 put to somebody, that's what they can do. So how does that work? If it closes below 220, which is apparently my max profit zone, if I close at 215, what's somebody going to do? They're going to force me to buy their stock. So I'm going to be out 220. I had 231.55. I'm going to be out 220. And now I'm going to get the Goldman Sachs stock, which, by the way, is what I owe my broker for shorting the stock in the first place. So I wind up getting to keep $11.55. No matter what price it is below 220, that's what's going to happen. Somebody's going to make me buy Goldman Sachs at 220. I'm going to turn the Goldman Sachs stock over to the bank in order to close down my transaction. Of course, this is going to happen all behind the scenes. The broker's going to take care of it. I'm going to walk away with $11.55. That's my max reward. Any price below 220. Now my max risk, 11.55. Let me go ahead and fill in all the blanks here. The percentage would be $11.55 divided by 231.55 gives me 4.9 rounded up 5% returns. Bailout price would be at $230. Looks like my cost basis is at $231.55. So my cost basis is lower than my bailout price. I could probably put my bailout price higher, or I can create a risk-free trade. This is no longer max risk. This is min reward. Because if I get called out at 230, I'm going to be guaranteed $1.55 of profit if I did my math right. How many with the show of hands follow? I can tweak these numbers all I want. Use a higher bailout price. Maybe I want to do that. But this is how we would work out these numbers. Now, what are the drawbacks to writing a covered put? Let me just finish the math here, and then we'll get into those discussions. There we go. $1.55 divided by 231.55 gives me about 0.7% profit. So my min reward on this particular trade would be 0.7%. My max would be 5%. And every cycle that I'm in between the trade zone and I don't get either bailed out or called out, my cost basis goes higher and higher. My max reward gets greater and greater, and my min reward gets greater and greater as well. And that's the idea behind a premium trade. But in this case, if the downturn occurs and Goldman Sachs bites the dust, I'll be in a better situation because the max profit happens down here at the bottom, not at the top. Okay, so we were going to discuss Why are these trades a pain in the butt? Well, first thing, I have to have a margin requirement to do this type of trading. I have to have a margin account. That means it's not a cash account. I can't do it in a retirement that has all the tax benefits of doing trading like this in a tax account, tax-free account, tax-deferred account. Also, because I'm dealing with this Goldman Sachs, I'm gonna have to short, both in the short and the covered calling situation. Because option contracts are in lots of 100, we're talking about needing a portfolio that has $22,932. I'm not even factoring in that the risk is too high for my portfolio. I wouldn't want to do my whole portfolio in this one trade. So that's a lot of money. A lot of people don't start with a portfolio that's $22,932. That's a lot of money or more. I would say for this type of trading, to get the risk to where I would want to have it, I'd need at least a $50,000 to $75,000 portfolio. A lot of people aren't starting with that. So that's another problem. So that's why a lot of people jump to doing these diagonal spreads. Now, it's easy to figure out how to do a diagonal spread for the covered call. All I'm going to do is I'm going to substitute Goldman Sachs with a Goldman Sachs deep in the money, far out in time call. Deep in the money because deep in the money options behave like underlying stocks, dollar for dollar. They're just cheaper. They're leveraged. Far out in time because I want to go as many cycles as possible selling front month premium against the back month option. I don't want to worry about the back month option expiring. Typically, the 6% protocol team is going 4 to 5 cycles before they get called out. My record is 14 cycles. Been trying to get 15 cycles, but haven't gotten there yet. 14 cycles of selling premium. Some of our 6% protocol traders are selling weekly premium at this point. I'm still selling monthly premium, mainly because of liquidity. So I'm actually picking far out in time options that are in the January 2019 timeframe right now. I'm using January 2019 leaps. So that's easy enough. Go deep enough in the money, delta of 1, intrinsic value, almost the whole price of the option. And go far out in time. I'll lower my cost basis, make the trade more affordable. Can I do that with the covered put? How do I create a replacement for a shorted stock? What does a shorted stock do? Well, a long stock does this. As the underlying stock goes up in price, I make $1. Goes up in price again, I make another $1. Goes up in price again, I make another $1. How many with the show of hands follow? All right, what does the shorted stock do? As the underlying stock goes down in price, I make $1. Another $1, I make $2. Another $1, I make $3. What does a put option look like? It looks like this, and then it hits a strike price and it starts being out of the money. And of course, unless it's right at expiration, it has some sort of premium value right at the money and a little bit in either way. But once you get deep enough out of the money and deep enough in the money, there's no more premium left. We call that trading at parity. And so the scoop is to get a synthetic replacement, or actually not a synthetic replacement, but a replacement to our shorted stock. We can use a deep in the money, far out in time put option. So looking at Goldman Sachs, how deep would we want to go? This will be the last discussion of the day because I'm running out of time. How many of you with the show of hands are having fun so far? Fantastic. Let's keep going then. If I want to see how deep in the money I can go, let's go out to January 2019. January 21st is the expiration date in 2019. Let's look at some deep in the money puts. How deep do we have to go? Well, first of all, I don't like the fact that there's not much open interest out there. That's a whole nother discussion that we can talk about. But let's see what we could do if we went out, say, for instance, to the 270. The 270 is currently trading somewhere between 51.65 and 53.40. If I was to put an order out there to buy one of those things, 51.65 plus 53.40 divided by 2. Maybe put an order out there slightly towards the ask side, maybe $52.60. I bet you I'd get picked up. Somebody would write me a put at that price. Let's put that into our analysis. So instead of selling to open Goldman Sachs, let's instead buy to open a Goldman Sachs January 2019 270 put for $52.60. Notice I just created a similar transaction to the covered call. I bought and now I sold. I sold premium against something I bought. By the way, how deep in the money are we? We're talking about the 270 strike price minus the current trading price of $229.10. I'm $40.90 in the money. To be honest, $40.90 compared to the price of $52.60, it's about 75%. That's not deep enough in the money. Let's go back to the drawing board. Let's try 300. Trading somewhere between 73.75 and 77.25. 73.75 plus 77.25. It's 151 divided by 2. 75.50. How deep am I in the money with my 300 put? If I'm currently trading at $229.10, 70.90. 70.90 of the 75.50 is about 94%. I'd even want to go a little bit deeper in the money. The reason is because I want at least 95% of the price of the option. Write that down. 95% of the price of the option to be in the money. Intrinsic value. For the sake of time, we'll go with this 75.50. So our cost basis now, 75.50 minus $2.23 for the near term at the money option brings me down to 73.27. Now, where does that leave me with respect to max reward? Where's my profit happen? Now my profit is the difference between where I would get unwound here at 220 and where I would have to unwind somebody else at 300. That's an $80 spread. So my call out price becomes $80. Where's my bailout price? Same thing. Difference between where I would bail out and where I would have to then unwind the trade. My bailout price now becomes $70. All right, $80 minus 73.27, $6.73. $6.73 divided by the cost basis of 73.27. I got 9.2% max reward. But even better, I've got a cheaper, I don't have to come up with $29,000, $22,000. I'm coming up with only an investment of $7,327. We've got a little bit nicer max reward. Let's figure out our max risk. 73.27 minus $70. $3.27 of max loss or max risk. Which is still doable. That's about a 4.4%. And again, don't forget, these are all buy rights, which means we could leg into these and really change our dynamics nicely. The scoop is not only is this a lower price to get into, but at the same time, guys and gals, this is a trade we can do in our cash account. It's back to the buying first, selling second, continuing to sell premium against our trade. And that's what a lot of folks are doing. This particular trade, it's called a diagonal debit put spread, is doing those dynamics that we exactly described. And that is we're profiting on cycle one if we go to the downside. We're continuing to make premium every month. And as we make premium, our profit zone gets bigger and bigger and bigger to our trade zone. But we're protected that first month. Our max reward happens to the downside instead of the upside. It's a really creative way to do this. A lot of our traders in the 6% protocol are doing that now. I've got some white papers for you as I promised. And I'd love for you to grab them. I'm going to make this nice and big so you can see them. Let's copy and paste that link. The link we've got for you is, oops, let's try that again. And this way Renee can put it into the chat box for you. Make it nice and big. It's called 6pp.today/videos-and-white papers. I'm really proud of these white papers. They're going to be featured in Bloomberg and CNBC. I'm the nerd behind the scenes for some of those popular folks on TV, 6pp.today. Also, if you have any questions about what I talked about, you want to learn how to do this stuff, just drop me an email or call me. I love to talk to people. That's the Trading Trainer office, and I'm at extension 81. You'll get me at my desk. So AJ at tradingtrainer.com, 970-266-8146, extension 81. And please go check out, we've got a video series there that you can check out about selling premium. And we've got my two papers. One's on scenario testing. One's on the math behind doing successful diagonal debit spreads.